Hello. Um, Good day. So this is now chapter 3-3 from the Mankiw book. And with this, we are going to truly introduce the classical model. Okay. Um, in this section, we discuss what determines the demand for goods and services. And in particular, we wish to examine how output from production is used. Okay. In other words, we're looking at expenditure. So in the previous sections of this chapter, we had discussed about how total output is made. The answer is production function with technology and inputs. Next, we discussed how that total output is divided amongst the factors of production in terms of factor prices and incomes. And this time we consider expenditure. Okay. All right. So there are four components of GDP that we had discussed: consumption, investment, government purchases, and net exports. For now, we will consider the closed economy. We will defer open economies till chapter 5. Okay. So a closed economy simply means that your NX is set to 0. So you have no exports or imports. Okay. There's no trade with other countries. In this case, the three components of GDP are expressed in the national income accounts identity. Y equals C plus I plus G. So this is the national income accounts identity, which is also your total income on the one side and your total expenditure on the other side. Okay. So your total output or income is Y, and it's going to be divided between C, I, and then G. So households consume some of the economy's output. Firms and households use some of the output for investment, and the government buys some of the output for public purposes. Okay. So let's talk about each component. So consumption. When we eat food or wear clothing, go to a movie, etc., we are consuming some of the output of the economy. So all forms of consumption together make up about 2/3 of GDP. There's a behavioral assumption that we are going to have here, in that households receive income from their labor and their ownership of capital, and then decide how much of their after-tax income to consume and how much to save. So the decision to consume will be a function of income after the payment of taxes, or Y minus T. Okay. So recall that Y is your GDP or output, and then T is the amount of taxes collected by the government. And that's in this sentence here. The government then taxes households an amount T. Okay. Now, this variable, Y minus T, is called disposable income. So households divide their disposable income between consumption and saving. We assume that the level of consumption depends directly on the level of disposable income. The higher the disposable income leads to greater consumption. And the relationship between consumption and disposable income is called the consumption function. The marginal propensity to consume is the amount of which consumption changes when disposable income increases by $1. Okay. The MPC is between 0 and 1. An extra dollar of income increases consumption, but by less than $1. Thus, if households obtain an extra dollar of income, they save a portion of it. So for instance, if the MPC is 0.7, then households spend 70 cents of each additional dollar of disposable income on consumer goods and services and save 30 cents. All right. And here is a picture of the consumption function, wherein this line is the consumption function. The x-axis measures your disposable income, or Y minus T. And then your consumption is measured in the y-axis. The slope of the consumption function itself is MPC, right? For every $1 increase in disposable income, your consumption goes up by the amount of MPC. All right. By the way, by this logic, 1 minus MPC is the amount of disposable income that is saved. So if MPC is the amount that is consumed, then 1 minus MPC is the amount that is saved. Next is investment. Both firms and households purchase investment goods. Firms buy investment goods to add to their stock of capital and replace existing capital as it wears out. So households buy new houses, which are part of investment. Total investment in the US averages about 15% of GDP. You can also take a look at how much investment is as a share of GDP in the Philippines. All right. So what is the behavioral assumption here? The quantity of investment goods demanded depends on the interest rate, which measures the cost of funds used to finance investments. For an investment to be profitable, its return, the revenue from increased future production of goods and services, must exceed its cost, the payments for borrowed funds, which is R, right? If the interest rate rises, fewer investment projects will be profitable because the cost for borrowed funds will be higher and the quantity of investment goods demanded will fall. Okay. Let's consider this example here. A firm makes the same investment decision. It starts here. For example, suppose a firm is considering whether to build a $1 million factory that would yield a return of 100,000 per year or 10%. The firm compares this return to the cost of borrowing the $1 million. If the interest rate is below 10%, the firm borrows the money in financial markets and makes the investment. If the interest rate is above 10%, the firm forgoes the investment opportunity and does not build the factory. So the firm makes the same investment decision even if it does not have to borrow the 1 million but uses its internal funds. The firm can always deposit this money in the bank or the money market fund and earn interest on it. Building the factory is more profitable than depositing the money if and only if the interest rate is less than the 10% return on the factory. All right. When studying the role of interest rates in the economy, economists will distinguish between the nominal interest rate and the real interest rate. This distinction is relevant when the overall level of prices is changing. The nominal interest rate is the interest rate that's usually reported. It's the rate of interest that investors will pay to borrow money. The real interest rate is the nominal interest rate corrected for effects of inflation. If the nominal interest rate is 8% and the inflation rate is 3%, then the real interest rate is approximately 5%. Okay, so this is in fact, the mathematics here is in fact an approximation of what the real interest rate would be. So if we have these numbers, which are relatively small, then the real interest rate is simply the difference between the nominal interest rate and the inflation rate. Okay. As an approximation, it's okay. In chapter 4, later on, we will discuss the relationship between nominal and real interest rates in detail. Here, it's sufficient to note that the real interest rate measures the true cost of borrowing and thus determines investment. We can summarize the discussion with an equation relating investment to the real interest rate, R. Okay, so before looking at the picture, again, we remind ourselves that R, or the real interest rate, is the opportunity cost of investment. Okay, in order to invest, okay, a given project, right, as the description that we had talked about earlier, if the interest rate is lower, then it's easier to invest. Investment projects will become more profitable because the cost of funds is lower, or the opportunity cost of funds, the alternative use of the funds is now lower. And therefore, investment should be easier to do. Okay. So therefore, there should be a negative relationship between investment and the real interest rate. So because again, you should consider R as a cost of investment. So they have a negative relationship. This is the picture for the real interest rate and investment on the x-axis. And if you'll take a look at it, it's negatively related to each other. They're negatively related to each other. Next is government purchases. So government purchases are the third component of the demand for goods and services. So different kinds of spending by the government. Government at all levels will produce goods such as roads and other public works. They buy for national defense, weapons, right? The services of government employees. They spend on education, like in the public sector, education in the public sector, and so on. These purchases are one type of government spending. The other type is transfer payments to households, okay, such as welfare for the poor, social security payments. Unlike government purchases, transfer payments are not made in exchange for some of the economy's goods of output of goods and services. Therefore, they're not included in G. Okay, so they're just transfers from one area to one part of the government to another part of the government. Okay. Uh, so what's important here is that G is basically the part of GDP, right, of the production of new goods and services that are purchased or spent on by the government. Okay. So now we have T, which we had discussed earlier, which are equal to the amount of taxes that's collected. Okay. So we can define T as equal now to taxes minus transfer payments. Okay. Disposable income Y minus T includes both the negative impact of taxes and the positive impact of transfer payments. Okay. If government purchases equal taxes minus transfers, then G equals T and the government will have what's called a balanced budget. If G exceeds T, the government will run what's called a budget deficit, which it will have to fund by issuing government debt. If G is less than T, the government runs a budget surplus. Here, we do not explain yet G, what determines G and what determines T. So from the purposes of this particular point of the book, we will then say that G is G bar and T will be T bar, which are exogenous to the model. So they're given values, right, that you can potentially change in a policy experiment. Now, what brings the supply and demand for goods and services into equilibrium? All right. So now we are complete with our description, right? And we can return to the circular flow. We began by examining the supply of goods and services, and we have just discussed the demand or expenditure for them. How can we be certain that these flows balance? In other words, what ensures that the sum of consumption, investment, and government purchases equals the amount of output produced? We will see that in the classical model, the interest rate is the price that has the crucial role of equilibrating the supply and demand for goods and services. So we can describe the model this way and see the important role of the real interest rate in making sure that total output equals total expenditure, right? Or the total production of goods and services equals the demand or expenditure on goods and services. Okay. So here is the model itself. So this 1, 2, 3, 4, 5, these 5 equations here, plus another one which we will discuss right down here, is essentially the entire model. Okay. So the first line here, this is the equality between output and expenditure. So your Y will have to equal C plus I plus G in equilibrium. These 3 equations or 4 equations are the ones that we had talked about earlier. That consumption is a function of disposable income and it's positively related to disposable income. That investment is a function of real interest rates R and it's negatively related to the real interest rate. Your G and your T are exogenous. That's why they're G bar and T bar. And further on, we also note that your Y will be a function of your technology, F, your K bar and L bar, which are your inputs. Which means if if both K bar and L bar are fixed, then your Y will also be fixed at Y bar. Okay, so this is in fact the final equation into the model. So what you should do to solve this model, like any other model, is to know what the exogenous variables are and what the endogenous variables are. There is a list of exogenous variables. G is exogenous. T is exogenous. Right? K and L are exogenous, therefore Y is exogenous. So what is the one thing that's remaining that's endogenous? Well, investment and or R, because investment and R, they're essentially determined because it's a function. Once you have investment, you have the real interest rate, or vice versa. Once you have the real interest rate, you know what the investment level is in the economy. And you'll see that here in this equation here, right? Because now we've replaced all of the variables that we can replace with their exogenous counterparts. You'll notice that Y bar is fixed. This is consumption, and you'll notice that consumption is a function of Y bar and T bar. Therefore, consumption itself is also fixed. And then G here is also fixed. And the only thing that's not fixed is investment and R. So the variable that makes sure that the Y bar equals C plus I plus G is in fact investment or the real interest rate. That's the price that makes sure that total output equals total expenditure on the right-hand side. Now, there's another way of viewing this. You can start with the equilibrium in the goods market, the expenditure and output that we had just talked about. Then you move from the right-hand side. So this used to be C plus I plus G. You move from the right-hand side to the left-hand side. Then it becomes Y minus C plus G equals I. So what is this? Y minus C minus G, that's called national saving. Okay, national saving because your total income is Y, then you subtract your expenditure from C, which is your private sector consumption, and then your expenditure from G, which is your public sector consumption. Whatever is remaining, that is saving. Okay. So in this form, the national income account's identity shows that saving here will have to equal investment in equilibrium. Okay. Another way of seeing this is if from this equation here, you add and subtract t. So here you have the minus t, and then down here you have the plus t. And if you notice, the t's will cancel out, but you're adding here and then you're subtracting there. So the reason is that your savings can be divided into two kinds of savings, right? Here is your private savings, your y minus t minus c minus t. Okay, so your total income, you subtract your consumption and you subtract your taxes net of transfers. So what is remaining after that? That's your savings, or the amount of output that is not consumed. So that's going to be called private savings. On the other hand, T minus G is going to be called public saving. If this is positive, then that means you are running a surplus. Okay. And you're not spending, the government is not spending as much as it's earning in tax revenue. And therefore, there is public saving. So national saving S, total saving S, will be a function, or the sum actually, of private saving here and public saving here. And the sum of private and public saving will be national saving, which will then be, of course, equal to the investment, the level of investment. All right. We can do the same step that we had before, which is to replace all of the variables with their exogenous counterparts to know what is left after you've done that. So you know that Y is exogenous, so you can replace it. Y is exogenous here as well. T is exogenous, so that's why you replace it with T bar. Your G is exogenous, that's why you replace it with G bar. And as you'll see on the left-hand side here, and it's actually all exogenous, and therefore the savings rate itself will be exogenous. Right? But in equilibrium, your investment has to equal your savings, right? So it cannot be different, okay, because we have to impose this as the equilibrium condition. And what is the price that makes sure that your investment equals your savings? It's the real interest rate. And that's the price that makes sure that your Y equals C plus I plus G. And it's also the price that ensures that your savings equals your investment. This is the illustration of what they had just talked about. So saving is a vertical line here because saving is just S bar. Okay. S is not, in this particular model, it's not related to the real interest rate. Okay. In other types of models, savings and the real interest rate are in fact related to each other. But in this one, it's not, because all of the elements of saving, national savings, are exogenous, right? If you recall, going back here, this is national savings. All of these have over bars on them and are exogenous. So saving is not related to R. That's fine. And then investment is here, but it is related to R. In fact, it's negatively related to R. There will be one point of intersection, and that is the value of R that makes your investment equal to your savings rate. And that is the equilibrium in this model. All right. And we can read this last paragraph. The interest rate adjusts until the amounts that firm want to invest equals the amount that households want to save. If the interest rate is too low, let's look at this. If the interest rate is too low, what's going to happen here is that desired investment will exceed savings. And that's not an equilibrium. Okay. In order to make it an equilibrium, then the interest rate must rise and reduce desired investment to exactly equal the savings rate. If the interest rate is too low, investors want more of the economy's output than households want to save. Equivalently, the quantity of loanable funds demanded exceeds the quantity supplied. When this happens, the interest rate will rise. Conversely, if the interest rate is too high, households want to save more than firms want to invest because the quantity of loanable funds supplied is greater than the quantity demanded, and the interest rate will fall. The equilibrium interest rate is found when the two curves will cross. At the equilibrium interest rate, households' desire to save balances firms' desire to invest, and the quantity of loanable funds supplied equals the quantity demanded. So you may be interested in what this loanable funds theory is. In fact, that's what the name of the section. It's going to be called the supply and demand for loanable funds. And that is in fact the intuition or explanation of S and then I, right? That's the loanable funds, right? From a quick glance of figure 3-8, here I'm reading this. One might think it was a supply and demand diagram for a particular good. In fact, savings and investment, S and I, can be interpreted as in terms of the supply and demand. In this case, the good is the supply and demand for loanable funds, and its price is the interest rate. Now, saving is the supply of loanable funds. Households lend their saving. Here we're reading this part. Households lend their saving to investors or deposit their saving in a bank and then loans the funds out. Investment is the demand for loanable funds. Investors borrow from the public directly by selling bonds or indirectly by borrowing from banks. Because investment depends on the interest rate, the quantity of loanable funds demanded also depends on the interest rate. Okay. So the interpretation here, guys, is S equals I. This is the equilibrium condition, not just of the market for goods and services, but you can think about this as the equilibrium condition in what's called the market for loanable funds, where S is the supply of loanable funds, okay, and I is the demand for loanable funds, which is called investment. Perhaps another simpler way of this is the same as the supply and demand for loanable funds, but ultimately, guys, if you are a firm looking to invest, you'd need to access money to do that. And the pool of available money is simply called savings. Right? Whatever is not consumed is saved, and therefore that's the money remaining to be used to invest. It's possible for the supply of loanable funds or the supply of funds that can be invested to be different from the demand for investment here. And the price that will equilibrate that is R, right? Like we said here. And this is the equation, no, not equation. This is the illustration of the market for loanable funds. It's also the illustration for the markets for goods market clearing, like we said, because this S mine equals I, this is basically the same as this one. This one. We're just rearranging terms and calling it S equals I. All right, so now we switch to some PowerPoint just to show people how it could look like and to remind each other that what we've just done here is introduce our first macroeconomic model. So on the left-hand side is the same picture that we had in the book. Take note that this one is the investment function, and it's negatively related to the real interest rate here. Your S is a vertical line because it's just S bar. So how can we show that? So here are your equations. Your first equation here, I'm just going to draw further some lines here, and I'm going to color this red. Here's your consumption function right here, right? Yeah. That's your consumption function. And typically, when we turn this into math, your consumption function will have a portion, A, that's not a function of your disposable income, and you have a part here, which is a function of your disposable income. C, the small letter C here, that's your marginal propensity to consume. So this is just a simple line that goes up as Y minus T goes up because C is a positive number. Next is, this is your investment line. I'm just going to draw this. Now, your investment line will also have a part B that's not related to the real interest rate. But take note that it's minus BR, where B itself is some positive number. So the investment here is negatively related to the real interest rate here. Okay. In fact, this line that we're drawing, which had become red, this line that we are drawing is in fact this one. Okay. And it has a slope of negative B. And it's got an x-intercept here. If R is 0, then your investment will be equal to B. So the maximal investment here will be equal to B. All right. The next ones here will be government spending and net taxes, G and T, and both are exogenous. And then lastly, this one is your production function, which we had said is also exogenous because your technology and your factors of production, K and R, are fixed. And then finally, this is the thing that's very important that closes out the whole model that everyone should remember. This is going to be your goods market equation or equilibrium equation, or your total output equals total expenditure. Let me change the color here. There you go. It's Y is your total output, and then C plus I plus G, that's your total expenditure. These next few lines here are about essentially following the book, right? So what's happening here is I'm taking this one and I'm bringing it down, but replacing all of the variables that are exogenous with their exogenous counterparts. So Y is not just Y, but now Y bar. You have Y bar here. The T becomes T bar. The G becomes G bar. So if you'll notice, the whole thing has no other endogenous variables other than R. So the thing that you're trying to solve at this point is R. So because that's the case, you're moving this part, which is the consumption that's affected by disposable income, and then your G, then you're moving it to the left-hand side, and then what you're going to get is Y bar minus CY bar minus A plus CT bar minus G bar. And that's going to be equal to B minus BR. Now this B minus BR, that's just your investment. That's down here on the right-hand side. So you're leaving investment on the right-hand side. On the left-hand side, you'll notice that they're all bars. Y bar, T bar, and G bar. Okay. They're all exogenous. And in particular, you can write them as Y minus C minus G. So this is C here, minus that's why you have a couple of minuses, minus this, minus that, because these two together are your consumption function. So it's Y minus your consumption function minus your government spending. That's just your national savings. And your national savings must be equal to your investment. What is the variable that makes sure that your investment and your national savings are equal to each other? It's the real interest rate R. And that's illustrated here with your R star. And you solve for R. This is the solution. This is the R that makes sure that your S and your I are equal to each other. And if these were numbers, so in a numerical exam, for example, the Y bar could be some number, C would be some variable, some number less than 1, and then Y bar would be a number, T bar would be a number. A, which is your exogenous consumption, which is here, that's also just some number. And then G bar is also just some number. And this will all be S bar, which is a fixed value. And that's going to be equal to B, which is a fixed value because that's your exogenous portion of the investment rate, minus B, R, and B can be any value that is greater than 0 because there's a negative value here. There's a negative sign here. So R will be negatively related to investment, but the value of the letter B itself will be positive. Now, having said that, you can see that it's what S bar will be equal to R. And it's IR, investment. And it's R, the real interest rate, that will equilibrate or make sure that investment equals S bar, which is this picture. Okay. So I would ask you to think about, try to come up with some numbers and plug in numbers here, making sure that they respect a couple of basic limitations or restrictions, right? So you can plug in any number. You can try this at home. Plug in any number here for your savings, and that's your savings here. But what's important, guys, is your savings has to be, I'm gonna copy this. It must be that your savings is always going to be greater than 0. Okay? At least in the closed economy. Oops. 0. Okay. And therefore, your investment R will also have to be greater than 0. Okay. So the values here are all positive. So you can choose any combination of numbers here for your savings such that Y bar minus C, Y bar minus T bar minus A minus G is a positive number. All right. So those are the limitations. But other than that, you can try it with real numbers and then you can solve for R. The next topic here, guys, are what happens if we change things. So as the government, you are able to change T and G. And in this particular case, we will discuss an increase in G, right, or in government spending. So what we can do is use exactly what we had before, which is S, which is on the one side here, and then I, which is on the other side here. So note that G appears on the left-hand side. And in particular, this is G right here. Correct? Okay. So what would you notice when you increase G? If you increase G, then your savings will fall, right? Because it has a negative sign. On the left-hand side, it has a negative sign. So an increase in G will make the S bar or the savings go down. Intuitively, an increase in G is basically an increase in government consumption. And if you increase consumption, then by definition, that means your savings has to go down. In particular, your public saving will go down. Okay, if your savings will fall, it must be that in equilibrium, your investment will also fall. Now, if your investment must fall, then because of the negative relationship between the real interest rate and investment, it's the R that must adjust, and therefore the R must rise. Here's another way of viewing it, which is closer to the numeric one, right? So if you'll notice, if G goes up here, there's a negative G. So negative G times a positive increase, that's going to be a decrease in negative G. So if the left-hand side goes down, then the right-hand side has to go up. Oh, sorry, has to go down also. Sorry, has to go down. This negative BR, okay, notice that the B here, the big B, has moved to the other side. So now the only thing that's left is on the right-hand side, which is negative BR. This whole thing has to go down. But because again, there's a negative sign there and small b is positive, it must be that R will go up. Okay. Because if R will fall, then it's negative times a negative, then that will be a positive. That's wrong. So that means if this whole thing will go down, it must be that R will go up because of this negative sign in front of it. Okay, so I will point you now. So that's essentially, I will point you to other examples. Here's an increase in government purchases. Um, and here are pictures of changes in investment demand. So changes in investment demand will naturally shift the investment curve here, which will then change your interest rate. Okay. In this market for loanable funds, or similarly, you can also call this the market for goods and services, right? Because it's about the equality between output, Y, and expenditure, CING. Now, when you're done playing, using the model, and again, I advise you as practice, you can literally put toy numbers in here. Choose any combination of Y bar, C bar, C, small c, T bar, and G bar, and this A. You can put any combination of those numbers as long as S bar is greater than 0, some positive number. And then once you do that, you can also solve something like this. Okay. And you can try solving it A, B, and C, right? You should be able to solve A, B, and C. Notice that these are the same things that we had discussed before. Y is Y bar, which is 5,000. G is G bar, which is 1,000. T is T bar, which is 1,000. Here is your consumption function, which is exactly this one. So now your A is 250. Your small c is 0.75. This is your marginal propensity to consume. And then your Y and your T come from here. So you can just literally plug in 5,000 minus 1,000 here. Here's your investment, which is 1,000 minus 50R, which is the counterpart is this one. So in the book, the big B is 1,000. Your small b is 50. And notice the negative sign there. There's a negative sign. So if you use these toy numbers, you'll find that savings is positive. So you can try to come up with whatever other toy numbers you can use to come up with S equals I in equilibrium, and try to solve for the equilibrium real interest rate, R star. All right, with that, that's it for this. I'll see you soon. And again, before you leave this chapter, make sure you consider doing this question, which is a numerical question. And perhaps even better, try to start with this and then change the Y bars, the T bars, and the G bars into a number, an S bar, which is greater than 0. So you can come up with your own combination of numbers. All right. See you. Bye-bye.